How big can this market go in terms of just deal size? I mean, could we see a $10 billion deal, a $20 billion deal? What do you think the ceiling is?
I don't think there is a ceiling. Michael Klein has already done a $10+ billion deal, announced a $10+ billion deal. And I think Ackman SPAC will allow him to do $20, $30 billion deal. The size, the reason I don't think there's a ceiling is that the larger the deal is, actually the better for the economics. In terms of the dilution from the SPAC promote or economics, it gets to be a smaller percentage. So it's actually better for the seller. I don't think there is a ceiling. I think the SPAC size of SPAC raise will continue to increase in size. There's a few $1 billion SPACs in addition to Ackman's and Michael Klein's. We have a $1 billion SPAC out there as well. And there's no limit to the ceiling.
And when you are going out to compete sort of, for targets, as you say, it's the IPO market is perhaps the right sort of comparison rather than the private equity model. How do you pitch the SPAC as being a better alternative, a better liquidity event for those owners than the traditional route of going to the public market?
I agree with you. This is more competitive against the IPO market than the private equity market because there are two totally different products. In a private equity transaction, obviously, you don't have liquidity. It's a longer tenure in terms of 4 or 5 year hold of private equity. And obviously, you have a lot more leverage in a private equity deal, whereas a SPAC deal, you have much less leverage. You have liquidity for the seller in that they own stock they can sell every day. And the leverage is significantly less. So it's two totally different products. So when you compare it to an IPO, the pitch is actually very simple. It is a better way of going public with sponsorship, with a very nuanced story. Remember, on a SPAC deal, you can go and tell the story in a different way with detailed projections, with a much more detailed set of financials and story. And you don't have the vagaries of the IPO market in that you can negotiate a bespoke deal with the seller. You can structure the deal in a tailor-made transaction. You can have actually a lot more proceeds to the seller. In an IPO market, you're confined by what the IPO ranges will be. And as you know, with an IPO transaction, depends on that week. If there's issues in the stock market and elections, the deal may or may not get done, and certainly may or may not get done within range. In a SPAC deal, you negotiate in advance what the price is going to be and what the structure is going to be. So it's much more tailor-made transaction, much more nuanced transaction, and also shorter as well.
As you mentioned, there's a sort of white-hot market right now in the SPAC space, but also a very hot IPO market. Obviously, that creates a lot more competition for the targets that are out there, the attractive ones anyway. How do you mitigate the risk of taking a company public basically too early? We saw Jeff Ubben the other day saying he was slightly upset. He felt that potentially Nikola had been taken public too early, was now facing scrutiny that it wasn't ready to face. How do you, as an investor, manage that risk when you are competing for the best companies out there?
It's just like in any other investment business, whether you're investing in SPACs, hedge funds, or private equity, there will be a number of winners and losers. And each firm will have their own investment philosophy. We like to target the highest quality companies with significant moats or barrier to entry that can have long-term compounding. Other people may focus on different things. And I think it's really very firm specific. As was the case in private equity, you'll have a handful of winners and a number of private equity firms that were started 20, 30 years ago are no longer there. I think the one interesting thing about SPACs is that when people talk about competition, I like to point out that the deal flow available to SPACs today is ahead of the capital formation. In other words, although you're worried about the $13 billion tripling to $39 billion this year, the deal flows available to SPAC has gone ahead of that, the capital formation, because the aperture has been opened very wide for SPACs. 4 years ago, it would be almost unheard of to talk about a $10 billion deal in the SPAC market. 4 years ago, it would be unheard of to have a company like us, a 100-year-old family-owned business that certainly could have gone public the regular way, certainly could have gone to a private equity firm, to choose a SPAC partner to go public with. And so I think now every Fortune 500 company, every investment banking firm, when they talk about an exit, I think SPAC is part of the parlance, part of the conversation today.